Awesome, awesome. Oh, Anthony, I want to say thank you for coming on to the channel. I think we're going to have a really, really good discussion here regarding first lien and what it can do for people out there, and have a
Yeah.
different perspective on mortgages in general, and to see if there's another option for people. So, first of all, thank you for coming on. And if you would, please give a small little introduction on yourself and the company.
Yeah. Um, I work with First Savings Bank, which is a division of First Merchants Bank. I help to lead our sales team, part of the branch, for a first position HELOC, first and HELOC product that we have in house. I also help in coordination with firstliehenheloc.com, which is a free educational resource to teach people about what this product is, how it works, who it works for, when it works, and gives them a chance to sort of learn more about that to see if it could be a good fit for them as well. So in terms of what I do now, that's a small part of me at this point in time. So
That's
uh,
awesome. Awesome. One of the things that really drew me to you and the product itself is the option, right? On how it's presented as, at least with the website, it's an educational piece, and it allows people to see another option or a different perspective on how to go about paying off a house.
mhm.
This is something that historically people may not even be aware of it. It's a relatively new concept in a sense when you look
Yep.
at the grand scope of when mortgages became available, going back, stretching back all the way to the 1930s, early
Mhm.
1930s, where mortgages were really meant for only the wealthy, and they were mostly what, short term, right? They were no more than maybe 10 years.
Yeah, if 5 to 10 year period. There are a number of different structures. There was an interest only option. There was an open ended line of credit option. Farmers would take out these loans, and it's an open ended loan, so they could put money in and take money out. So they take money out to buy seed and livestock and fix their equipment at the beginning of the season. They plant and then harvest and then sell, and they take the money and put the money back into their mortgage that's secured by their home. From an amortized structure, they did have 5 to 10 year sort of amortized mortgages, but nothing in the 20 to 30 range. And so the payment that comes with a 10-year mortgage is pretty high. And so in the grand scheme of things, so it cut out a lot of people from being able to become homeowners. So you're right. It at that point in time, whether it was designed for the wealthy or whether the wealthy were the only ones that could take advantage of homeownership, that was the type of structure that was available back in the day. Before the 1930s, you had what's the book? There's a book out there. I can't remember. It's about when the Federal Reserve was created,
The Future
and
of Jekyll Island.
Future of Jekyll Island. That's it, right?
There you
And
go.
so, yeah, thank you. So, um, that sort of outlines the formation of the Federal Reserve and the sort of powers that were behind it. But during that conversation, that build out, they also decided that they wanted to create an amortized mortgage structure that's longer. There, the intention behind that was that they understood the value of homeownership for
Right.
upper middle class and lower middle class, individuals. So they understood the value of that in terms of being able to build wealth and sort of creating a forced wealth building system, right? And so what they did is by extending the term from a 8 to 10 year only term to a 20 to 30 year term, it reduced the payment to make the payment more palatable for regular people. So now regular people can become homeowners. And so that was the incentive, is to increase the number of homeowners that were able to qualify and buy homes. And so they put a number of things in place. They had standardized underwriting practices that came with that at that point too. And so for that purpose, it was a really, really good move.
Yeah, it did a couple of things. It definitely opened up the base, right? Allowing those who could not necessarily afford, because before this, banks would require 50 to maybe 60% down payment
Yeah.
on a traditional mortgage. This allowed for smaller portions upfront, perhaps, to be put in. And what it also did, from my limited understanding of it, was definitely during the recession time, or rather the Great Depression, it threw a lot of volatility, right? And what this actually did by spreading the payment out over a longer period of time created more market stability, so to speak.
Yeah.
Not only for the individual, like the family, but also for the banks too. Because again, it is a banking product, and they are going to look out for themselves, right? Um,
Yeah.
like any business would. So it was providing on both ends. Let's say it was providing
Yeah.
stability within the market itself. It also reduced bank risk, essentially, because
Yeah.
the family had, if they knew that they had this particular asset for a longer amount of time, then it also helped them with their books, as well as the individual, because now the individual didn't have to put more up front. They could take that lower payment
Yeah.
over the stretch of the time, and they would have, like you said, the amortized interest kind of played out and showed them everything up front, as opposed to having perhaps a balloon payment at the end, in
Right.
which if you didn't refinance that balloon payment or have the money to pay it, you were essentially losing the asset, right? The bank was then going to take the
Yep.
asset. And
Yeah.
from
So
the most
before,
parts,
yeah.
but real fast, from the most part,
Yeah.
I think you can attest to this, and correct me if I'm wrong with this statement, but banks really don't want to hold on to homes, right? I don't think they want to have the home. They're not in the business of home ownership.
They're not in the business of buying homes.
Right.
Correct. They're in the business of making interest, or earning interest dollars off the money that they lend.
Correct.
And sometimes the money that they lend is secured by real estate.
Yep.
But they don't want the home. They don't want you to foreclose. That's actually one of the worst case scenarios for the bank,
Right.
because again, that's not their business. Their business is earning interest income on money that they lend out. And so that's their whole model. That's the purpose of that business. So you're completely right.
And let me say, this is why I think the first lien HELOC is so unique, because what their bank is essentially doing with this type of product is they're allowing more flexibility for the person, while still allowing them to take the home ownership earlier, right? They're getting it off of them and more onto you as another option, as opposed to taking the more quote unquote, for the last, what, 60 years of what has been now traditional way of doing things, of taking a 10-year, or rather a 20 or 30-year mortgage. Now giving you an option where, you tell me if I'm wrong with this statement, where if people who are qualified, because again, you still have to qualify for this particular product, for people that are qualified, you can see home ownership done, or with the payments completely done, within 7, maybe 10-year average.
Yeah. So when the product works for the household, when the household aligns with what the product requires to be successful, that's the kind of outcome that we'll see. It's not a one size fits all for everyone, just like anything in the shelf at the grocery store, right? It's not going to be for everyone.
And I think that's a very important point.
Absolutely.
It's not a one size fit all. You have to qualify for this. We have to have certain things in place. But for those who do, I think, go right ahead. I think this is an option, but go ahead.
So I think one thing to consider is with the amortized mortgage, why would you ever want to look for something else, right? Why would you ever want to do that? And so, the amortized mortgage does a good job of creating forced wealth building. It does that. It made homeownership available for the majority of Americans in the United States, which improved the quality of life for the majority of people here in the States that choose to become homeowners, and they're responsible homeowners. That wasn't accessible before this was available. So I don't want to ignore the fact that there are major benefits that come with the amortization schedule, but that sort of structure also comes with a couple realities too. I don't know, Chris, or anyone else watching, if you've actually looked at the amount of interest you're going to give the bank over the life of your loan, right? Yeah. What loan officers tend to do is they say, hey, well, at the closing table, I know this because they've told me that they say this. don't even look at the amortization schedule because it's going to cost too much. Even when you've got a good rate, even when you're proud of the rate that you have,
Yep.
you're like, you're going to give the bank so much money, just don't even look at it.
Yep.
Right? Just follow the deal. Right? Well, that's if you keep the house for 30 years.
Exactly.
And that's the best case scenario. You keep the house for 30 years because as time goes by with the amortization schedule, more of your payment goes to you. More of your payment goes to the principal and less goes to interest. At the very beginning of the amortization schedule, you give the most amount of that payment to the bank.
Yeah.
Well, as time goes by, if you're paying 30 years, right? If you're on year 27, the majority of your payment goes to you, and you're in the best position possible in that schedule. There's a graph that you can, where they kind of intersect.
Yeah. And that happens right around the halfway mark. So if we went with a
right
30-year,
13, 14 years, that's when you start giving yourself more money.
Exactly. And to your point, the best case scenario, like you just said, is if you stay in that house 30 years. And what's crazy that people don't necessarily understand, I did a video, my last video was exactly on this, about 70 to maybe 85% of that monthly payment, mortgage payment, is going to interest only, like you just said, majority.
At the beginning, that's where you start. You start with about 75% of the payment, give or take, going to the bank, and whatever's left over goes to you. So you make a payment, the majority of it goes to the bank, and whatever's left over goes to you, which means when that amount is very small, you're not paying the house down quickly. You pay the house down very, very, very slowly with an amortized mortgage structure. Yeah. Well, when you maintain a high balance for a long time, even if you have a low rate against high balance for a long time still results in a lot of money being given to the bank.
It's a lot of payment for sure.
That's something that loan officers don't analyze. I don't think they hide it. I think they don't even think about it.
I think it gets lost, what is the phrase, lost in translation, right? It doesn't necessarily compute as well, because if anybody's looking at this, it's like, why would I want to pay an institution $200,000 more or potentially $400,000 more over the course of the time? And on top of it, we know this from data that an average amount of time spent in a home is less than 10 years. We're looking at an average time of maybe somewhere in that 8 to 12 year range is when a family tends to stay in a home. Right. And you just mentioned it before, 13, 14 year mark is right about the tipping point where now more of your payment is going to the principal as opposed to the interest. And if we're constantly on the move prior to that, are we ever really, is the individual or the family ever really getting to the crux of that mortgage, of that loan?
Well, I think the answer, just thinking about the numbers, the answer is no. To me, it's less about getting to that crux and more about the total number of dollars you're going to give to the bank over the life of your loan, over your lifetime of being a homeowner.
Absolutely.
And so if you live in a home for 8 years, and then you refinance, what happens is, you refinance into a new loan, you go back to the beginning of the amortization schedule. So all the headway that you made toward flipping the script to where now you're giving yourself more money to the bank, all that headway goes completely away. You start back again at the beginning, giving the bank 75% of the payment or more at that first payment. And what happens is, if the average, the average time people move is 7 to 8 years. That doesn't account for refinances within when you own the home. And so more. I don't know the data on that, but if it's going to be more than every 8 years,
yes,
just from a law of averages. And so if we think about that, people are resetting the amortization schedule multiple times. And the only time they ever really pay themselves more, if we think about this as an average, the law of averages, then it's the last home that they ever own. So they're giving the bank the majority of their payment for the majority of their lives.
It's absolutely crazy.
Is crazy. And people don't bring that to light. It's true. It's a reality. If you're going to choose an amortized mortgage structure, that's what you're facing. That's true. Mathematically, it happens. And so the thing is, the banks do like that.
Yeah,
The banks like when you give them more of the payment.
absolutely. Because you're
The
continuing,
amortized,
it's
right?
continuing, right? It's just a constant payment. And
Over and over, you get a new mortgage and you give the bank most of the money. You pay it down to where you're giving yourself a little bit more, then you reset and give the bank most of the money again, over and over and over. Of course, they like that,
it's a cycle.
right? It's a
They love
cycle.
to keep you in that cycle.
And so it's easy for me to, I have an incentive to bash the amortized mortgage just because that's what we compete with.
Yeah.
I don't want to ignore that there are good things with it, right? It allowed for regular people to be homeowners where before only the wealthy were. That's
Right.
good. That's a good thing.
Yeah.
It's a forced wealth building scenario. So for homeowners that need to have that need to have a fixed payment, right? For them to pay, and it forces wealth building, good, if you need them, right? So I don't want to ignore the fact that there are positives with it, but it comes with a cost. It does. And that cost is giving the bank an asinine amount of money. I mean, it is just crazy how much you give. So just case in point, if someone were to, I think 5.2 is the interest rate, where if you buy a $200,000 house, you pay $200,000 in interest over 30 years. So if you think about that, at that interest rate, which right now the going interest rate for 30-year mortgages is higher than that. So if you were to continue with that mortgage for the life of the loan, which again, what we say is people don't, which is actually worse than this. But if you were to do that at a 5.2 rate, you're buying yourself a house and you're buying a house for the bank.
That just seems like crazy talk. Just seems like
that seems crazy talk. And so what we like to do is dial in on that, right? And understand what that looks like and focus on the dollars that people are going to give. How much money are you going to give the bank with the loan option that you choose? How much interest income are they going to earn off of you? How much of your hard-earned money is going to go to them and not stay in your own pocket?
Right.
And so
totally on board with that.
That's our focus. And so when we talk with people about our product, the First Lien HELOC and how it works, that's our focal point, because we want to help people.
Yep.
We want to help them save money, and
people. I want to dial down into that because we're mentioning in it the amortization interest, and First Lien HELOC attacks that essentially. That is the crux of it, and that's where we attack it differently. So that's where I want to continue the conversation, is now on the difference between the amortization interest versus what First Lien HELOCs do as compared to that. Now, it's a different type of interest. Am I right in saying that?
In a way. There are people who teach this and talk about this in a way where they call this simple interest versus amortized interest.
Now, I will admit I'm kind of one of those individuals that show it in that type of front as a way of differentiating between the two for people to understand it a little bit better.
So I'm going to get technical with you, but that may just be a difference in how we define simple interest.
Gotcha.
If I think about simple interest, to me, the opposite of simple interest is compound interest. So I've got simple and compound. And so compound interest is where you pay interest upon interest.
Correct.
So compound interest is usually talked about in terms of stock trading. Right.
Exactly.
Yeah, it's growing money, right? Your account grows and now you earn interest on the higher amount.
Correct.
Which is you earn interest on the principal plus the interest earnings that you receive.
Correct.
It works the same way when you're paying interest, right? You can pay interest on a balance that's created when an interest gets added to it. This does work that way because the First Lien HELOC pays its own interest.
Yes.
So the interest charge gets charged to the HELOC, which increases your HELOC's balance, which now that higher balance creates the new payment.
Correct.
Right. And so that, to me, the First Lien HELOC, when the balance is increasing due to interest payments happening, that would be defined as compound interest, not simple interest.
Understood.
Now, the people that other people I've talked with in terms of the reason why they call it simple interest is their argument is that even though the interest gets paid by the HELOC, when you're using this correctly, you're actually driving down the balance.
Right.
And so when that's the case, if we're assuming that's true, then you're not paying interest on a higher balance. You're paying interest on a lower balance, which that is in line with simple interest.
Correct.
So in terms of when people use it the right way and the balance is decreasing every month, then yes, I would be able to adhere to that assumption. Gotcha. If I'm comparing between simple and compound, the reality is this loan does allow for you to pay interest upon interest, which to me is compound interest as compared to simple.
Understood. Okay.
So that's just a side note.
Yeah.
But in terms of how this is different than an amortized mortgage, both use a balance at that point in time, and both take the rate and put the rate against the balance, and that's what creates the payment.
Correct.
And so that's true. The way that a first lien HELOC is different than an amortized mortgage is an amortized mortgage looks at the balance on the last day of the previous month. Correct. And uses the balance on that day against your rate to calculate your payment. With a first lien HELOC, it doesn't use the balance on that one day. It takes the average balance for the whole month. We call it the average daily principal balance. And it uses that average balance against your rate to calculate your payment. An easier way to think about that, because the math checks out both methods to arrive at the same end result for this, is using the average daily principal balance to calculate against the rate to calculate the payment is the same as taking a daily payment for each individual day's balance. Okay. So the end result is the same. So if I look at today's balance, that creates a daily payment. Tomorrow's balance creates a daily payment. And I add up all those payments, those daily payments throughout the month. That's the same end result as if we take the average daily principal balance. I like to explain it that way because people connect. It's a simpler model for people to understand. Every single day counts. Yeah. Every single day matters here. So
and that's the important. That's the important thing right there, right? And I think that's very wise to point that out to get them on the same page, so to speak, because now you're going to tell us why that little piece and that nugget actually can work in our favor.
Exactly. So understanding that every single day's balance matters naturally leads into the next part. Well, if I know that tomorrow's balance matters, I want to create a low balance tomorrow. Right. I don't want to wait 5 days. I don't want to keep my balance high for 5 days and then create a low balance, right? I want to get the balance low tomorrow. And I don't want to create a little bit of a low balance tomorrow. I want to create the lowest balance I possibly can tomorrow, because tomorrow's balance creates a daily charge for me.
Correct.
And so understanding that leads into the first part of the strategy, which is just create the lowest balance as fast as you can. Well, the way that plays out in real life is anytime we receive income, we deposit into the first lien HELOC as fast as you can.
Correct.
Right. And so that's how that translates to our action in real life is anytime I get income, I deposit the money in the first lien HELOC, which pays it down. People that hear that and then they adhere or that they fall back on what they understand about home loans, they think that naturally the gut reaction is that's crazy to put all of your money into your mortgage, because amortized mortgages are closed-ended loans.
Yes.
Right.
Another important topic. Yes.
Another difference, right? They're closed-ended. And what that means is every dollar you put toward your amortized mortgage is just locked away unless you do a cash out refinance or unless you sell the home. You can't take it back out. It's
Correct.
I like to think of these loans follow different rules, a different rule set. The rules of an amortized mortgage is that it calculates interest using the previous month's end balance, and it's closed-ended, which means money's locked away. First lien HELOC functions differently. It's an open-ended loan.
Yes.
So here you can safely put everything toward this, because open-ended means whatever you put toward this, you can take back out.
Correct.
So money you deposit in pays down the balance. Whenever you take the money back out, it increases the balance. And so, so you can safely put everything you have toward this because of the fact that you can take it back out.
Yeah, I remember when Corinne and I first started this process, at the time we were living in New York, and we were on a biweekly schedule with our checks from our jobs.
Hmm.
And what made it even more interesting was our weeks of payment were opposite of each other. So I, let's say, got paid the first and third week of every month. Corinne got paid every second and fourth week of the month. So every single week, we were having stuff going right directly into the HELOC. And every week, we were driving that principal, that amount owed, down and down and down.
Yep.
And you really, really effectively saw that loan balance just go down quicker and quicker and quicker. And it was just like, wow, we never saw that type of traction before. And
Right.
one of the effects of that, because as we mentioned earlier in the beginning, you're not seeing that principal payment go down at all. It's very, very slow. With this, you're seeing that principal number go down very rapidly, much, much more rapidly than you had with a real traditional
Right.
mortgage.
Yep.
And in conjunction, I don't. I think think we'd be remiss if we didn't add this. I know we kind of mentioned it, but there is a strategy to this, and you have to know your numbers, right? And when I say
Absolutely.
this, you have to understand how much money is actually also going out, because you mentioned this is an open-ended loan. This is not
Yep.
completely different from that mortgage, where you're absolutely right. You can't just go and pay a mortgage to the bank and say, here's the payment. Oh, and then come back like 3 days later and say, hey, listen, something just came up. Do you mind if I just take
I need
back?
I need a little bit of that.
Yeah, can
I
I
need
can I
some
just
back from that.
take back about $1,000 off that 2,500, that 3,000 that I just gave you? Something just came up. The bank's going to look at you and say, "What, are you nuts? No, you can't do that."
Right.
And that's that closed loan option. Whereas
Yep.
you're right, this is that open-ended loan option where you can funnel money in, but if something does come up and you need to pay for something, let's say monthly expenses, for example,
Yep.
you can now take that out of that HELOC account, pay
Yep.
it. Yes, the loan principal does go back up a little bit,
Yep.
but the overall interest will hopefully you didn't spend more than you brought in, and that's also one of the big things, will be lower, right? That whole
Yeah.
payment there is lower.
So to piggyback on that, right? The first part of the strategy is to drive everything in here, which means this is where everything that you earned is sitting. If that's the case, then you don't have money sitting anywhere else to pay for your things,
Right.
right? So this is where you need to pull from to pay for your bills, to pay for your expenses, your liabilities. All of your monthly expenses pull from this. So that, I mean, if we think about an overall monthly strategy as to what this is, you deposit all the money in, and that pays down your balance. It's a subtraction problem.
Right.
And then you pull from this to pay for all of your bills, and that's an addition problem.
Yeah.
It's literally subtraction and addition. It's no more
So
complicated than
simple.
that. There's more going on that we'll dig into, but the overall concept here is subtraction and addition. And
Yeah.
so I like to simplify it that much because it's so foreign to people.
Yes.
This is brand new in the United States for most people. So one of the loans, just to really quickly, sort of side note,
Yeah.
one of the loans that was available before the 30-year amortized mortgage was an open-ended line of credit secured by your real estate. It was this loan. This loan has been available in the wealth management division of your big banks, your Wells Fargo, your Morgan Stanley, your US banks, your Bank of Americas, your Chase, but they're not offered to everybody. It's only your wealth clients. And so this loan has been available to people for a very long time here in the United States. It's also, across the world, it's super popular as well. So, so all in all, it's not new, but it's new to a lot of people. And because it's new to a lot of people, you've got these talking heads on YouTube that's like, hey, I've got this home loan you've never heard of,
Right.
and you can pay off your home in like 7 or 8 years as compared to 30, and you can save a bunch of money. And oh, by the way, you deposit all your money into it and you use to pay your bills. That I understand the skepticism that comes with that.
Yeah, definitely.
And
Because,
so,
like you said, if it's been available this whole time, but it's only been available to a certain section of the market in people, right?
yep,
Market people of the market, then yeah, the vast majority would consider this to be new. And
yep,
I don't find that to be a far-fetched idea to label it as that. um, because of that simple factor. And I love the way you laid it out that way. Was that again? This is something now that people have more access to now, right? And
Yep.
by us discussing, having this type of conversation about it, and coaches and people that promote this product, such as we do, and different and other colleagues of mine, it's only going to hopefully reach the masses even more to show them, hey, listen, here is another option. We're not saying this is the greatest thing for you. We're saying that, hey, this could be the next thing for you, because wherever you are now, let's at least evaluate it. And I
Yep.
always like to put it this way, and I always tell my clients and all my prospects, I say, hey, listen, if I had the opportunity to show you a path that could save you up, tens of thousands of dollars and maybe up to hundreds of thousands of dollars, depending on where you are and what you're dealing with, wouldn't you at least want to hear and know about it? I'm not
Yep.
saying that it's the greatest thing for you, but wouldn't you want to at least hear and know about it? I
Yep.
would, just because that's just me. I'm always a knowledge guy. I'd like to go out there and at least understand a lot of things. I may not act on a lot of things, but at least I understand and know that it's out there.
Yep.
And that's the kind of the way I go about this. And I love that the way you said it that way, because it's so true. Um,
Well, and
People need to
the
know.
the thing is, like I tell people this all the time. Um, I don't sell the product. I sell the education. Now, we don't monetize the education,
Right.
right? It doesn't cost anything, but that's my job. My job is to go sell this concept to people. Hey, learn about this.
Right.
It may not be good for you. If you think about that whole money goes in, it pays down the balance, you take the money out, right? In terms of self-filtering,
Yeah.
who does this work for? Well, if the amount that goes in pays it down a lot, and the amount that comes out, your bills, doesn't increase the balance very much, then this has a pretty high likelihood of working for you. That's a household that's disciplined their finances, that makes more than they spend, that lives below their means, right? That's who this works for. Now let's think about a scenario where the income that pays down the balance is about the same as the expenses that come up, right? Down by 10,000, up by 10,000. It doesn't matter how much money you make. Down by 20, up by 20.
Yep.
Right? Down by 20, up by 20. It's that you would never pay off the house.
Nope.
So how does that translate to who this doesn't work for? Well, for households that are tight in their budget, households that have challenges with budgeting or knowing kind of where your numbers are. If you're struggling month to month, this won't be the saving grace, right? This wouldn't provide value for that particular scenario. And there's no one that's better or worse. That's not kind of where I'm going. But in terms of knowing when this particular product provides massive benefit, it provides massive benefit when the household has a surplus, when they make more than they spend.
Yeah,
And when
I agree with that. I like to say we got to look at your cash flow. We have to look at how positive your cash flow is, because if you are positive cash flow, at least you're on the right trajectory. It still may not be the right thing for you at this particular time, but you're on the right trajectory. If you're, like you said, flatlined on your cash flow or even negative, we have some work to do prior. It's not saying we can't get there. We're not there just yet for this particular product. We have other things that we need to look at first.
100%. So that's a key understanding in terms of generally speaking, who is this a good fit for, and who won't benefit from this.
Yeah.
And so the thing that I really like about this is that all I have to do is convince people to want to learn about it, help them self-filter based on a couple general things, and then ideally there are just people who want to learn about it and see what their outcome could be. With that, we have a calculator. You use it too, and or you have your own version, and basically you input the current balance, the rate we want to use for the HELOC, and the income and the expenses, along with a couple other items that are important for us to know.
And if anybody's interested in taking a look at that calculator, I'm going to have it in the description of this video. So in the description of the video, you can go in, you can click on that link, and it'll bring you to a little bit of a survey to kind of just see roundabout. It takes what, maybe 5 minutes to complete, if that,
Yeah, it's
maybe
pretty easy.
10.
Yep.
It may ask you for some numbers. Don't freak out. It's pretty simple stuff. You just go in there, you fill in the information, and it'll let you know pretty much right then and there whether you may be a qualified person or not.
Yeah.
And
It's
from
so that goes in line, when people end up talking with us, the first question we have to ask is, should this person even get this?
Yeah.
Forget can you get it? Forget can you qualify? We don't even talk about loan terms and all that. We're not trying to get them into the loan
Right.
at all at the beginning. It's like, hey, do you understand this? Do you kind of know how it works? Does this work for you? And that always falls back on that calculator.
Yep.
Because the calculator gives results on the expected payoff time, and that's a fun factor to look at.
Yeah.
And that's one that people
so
adhere
crazy.
to, right?
Oh yeah. Yeah,
That's what they're attracted to.
I could tell a person, you're in 27, you're 27 left, you have 27 years left. Hey, guess what? I can get you down to 11. I can get you down to
Right.
10.
And that factor is the exciting one that people are attracted to. To me, the more important one is, how many dollars are you going to give the bank compared to your amortized mortgage? That's where our focus is. and we'll calculate the amount of remaining money you have left to pay on your mortgage, and we'll compare that to, if you were to do a first lien HELOC, what would be the total cost?
Yeah,
and
you going back to that, mentioning that again, just brings up that story that you mentioned, those basic numbers of, an interest rate of 5.2 on a $200,000 house, where over the year of 30 years, you're now buying a whole nother house for the bank on the amount of interest you've just paid. So that means the person is paying $400,000 over the course of 30 years on a very, I would say, reasonable or mid-range rate comparatively today at 5.2.
At this point, yeah.
Right? That's insane.
On a $200,000 house.
Now getting to that, because of that, another comment, I'm going to go forward here with this because I think this is very important, and it runs along the same lines here. We're talking the interest rate. I mentioned the interest rate. You mentioned the interest rate at 5.2. Now, we also did mention that there's a difference between an amortized schedule and the HELOC schedule, or what we say maybe simplified, or however we want to define it. There is a difference there. And this is where even the most savvy people who are very into numbers and very into real estate, they'll look at this and say, well, I got a good, quote unquote, good interest rate at 3.5%. And there's no way you're going to get me to go to something that is going to get me any high. Why would I go from,
why would I ever?
Well, exactly, 3.5% to anything that's higher rate?
Right.
It doesn't compute. Regardless of what, it doesn't compute. And I'd like you to kind of address that, because this is where a lot of people, again, very smart people. We're not talking about, people that have no idea what's going on. These are very, very savvy. I can attest. There's a person I know owns multiple homes, very big into real estate, and he kept on coming back. I got too good of an interest rate. Why would I want to affect that? Why would I want to change? Right? So if you could kind of go and address that issue, because it's one that hangs up on a lot of people.
So the amortized mortgage, which is the kind of home loan that we all know about, comes with certain assumptions because of how it works. And the interest rate with an amortized mortgage is the only factor that's worth analyzing, because it has the greatest and sometimes the only, changing the rate has the greatest impact on the overall cost. Absolutely. And so we can legitimately, safely is not the right word, we can legitimately talk about the interest rate as a direct relationship with the total cost, because it has that. Right. But there are actually three factors that drive to the cost. The other two we just don't talk about with an amortized mortgage, because they're static, they're set, and that's your time and your balance. Yep. And so the amount of time that you're paying interest actually matters. I use extreme examples with when I'm talking with people, so they can connect with the concept, and then I apply that to others, to the same scenario, just not as extreme. So the one I like to use is, I'll ask them, would you if you could pay off your home in 1 year? Well, they're like, well, I can't. I'm like, well, just pretend. If you could pay off your home in 1 year, would you be scared of a 13% rate? And they say no. I'm like, okay, why not? And they're like, well, the rate's so. The time is so low. I paid off so fast. I'm like, exactly. The shorter the time, the less the rate that matters, right?
Right.
And then we'll talk about the balance. And this one's a little bit more obscure. I'll like, would you rather pay 10% on a $2 loan or 3% on $1 million, right? And they're like, well, I'd choose the $2 one. I was like, no. Would you choose the high rate or the low rate? And it's really hard for them to say it.
Yeah.
Right. Because they're like, I would choose the high rate one.
Right.
I was like, well, why? Well, that sounds crazy. Why would you ever choose the high rate? And they're like, because the balance is so. I'm like, exactly. So then I kind of go into, well, let's just pretend there's a loan out there that, because of how it works differently than what the loan that right? That you can pay it off really fast. You can arrive at a low balance. Is it possible that is it possible that a higher rate loan could outperform a lower rate loan if they function differently, and you can accomplish that? And then the answer is yes, it's possible. So at that point, right, then I've been able to help them see how it's possible. And now we've got someone who is a learner, right? The thing is, the assumption that the rate is the most important factor is true for an amortized mortgage. People aren't wrong with that. They're right with that. But this isn't that. This is a completely different home loan. So we don't know if the rate's a big deal or not.
Right.
We can't know. I mean, I don't know. What I do know is I can't know. I know that I can't know that they're the same. So we cannot take our understanding of interest rate and its level of importance and apply it to something that's completely different.
Yep.
Right. So we need to find out. And so, I mean, in theory, and we prove this out using the calculator day in, day out.
Yes.
But when the payoff time is very, very short compared to the other payoff time, when you pay down the balance very quickly, which you do if the payoff time is short, then you pay a very small amount of dollars to the bank in interest, even with a higher interest rate.
Yes.
And so we don't know until we put in the person's numbers. I can't make it work. I know what to do to make the calculator work, but if we're receiving the person's, the household's budget and how they actually function from a spend scenario, I can't control whether it's a good outcome or bad outcome. It just is what it is.
Right.
And that's what I love about this, because I don't have to sell the loan.
Right.
It
math
either
is
works.
math. You can't out math, and that's what I kind of coach people on. It's like, listen, you can't outdo math. Your numbers are your numbers. It's your habits that can change, and it's your perception on things that can change. But the math is the math. You either need to make more, spend less, or we have to prioritize differently here and there. But you're absolutely right. You can't make it work, right? It just you can't finagle it to make it work for everyone. And I absolutely love that. And one of the features that you're basically saying, right? You can't compare apples to oranges. We need to, because they're two different fruits. They're two different beasts. So, but what I do like, and this is in the calculator that we have, and that's going to be provided in the link, is that once you throw your numbers in there, and let's say it is a viable option for you given your numbers, I like the portion there where it shows the effective rate. Right?
Yep.
So now that we've put in our numbers, we have our traditional, and now we have with the new HELOC loan, and we've now comparatively put everything in, we now can take, right, because it's almost like reduction, right, in math. We can now take the reduction, bring it all the way down to the simplest terms, and now we've taken something that's an orange and now made it into some type of an apple, so where we can now compare apples to apples. And they're either the effective rate of a HELOC is either very close to, or sometimes better, I would say even better, more effectively better than the interest rate on your amortized mortgage loan. So I love that because it actually goes to show like, hey, listen, you were so caught up on the rate here at 3.5, but if you really ran it the way we have it down here, you're effectively at maybe a 2.8. And that's not
Yeah,
uncommon.
right. It's not uncommon when this works. To sort of clarify or add a little bit to that, the first thing HELOC product, the rate's going to be higher.
Yep.
It's going to be higher. Um,
And that's
I
what
might have
scares
had.
people right off the bat. It's like I
Oh
have
yeah,
a
yeah.
higher
No, no,
number.
that's it, right? And I name it, and we rip the Band-Aid off because that's the reality. The number that you see on the paper in the field for the interest rate is likely to be higher than the number you're looking at on paper with your amortized mortgage. That's probably going to be true, and it's variable too, and that freaks people out because it changes. Well, just for some perspective, right? Variable rates go up and down, right? It's not like the stock market where it continues to rise. There's sort of this weird sweet spot historically, which is around the 4.755% range for mortgages, right?
Okay.
I made that up, but I should look and see. That's what my gut says. Everyone I made that up. I'm sorry, I made it up. I didn't mean to. But here's the thing. There's going to be like an average, right, sort of rate where mortgage rates work, which means that 50% of the time a variable rate product is going up, and 50% of the time it's going down. So this idea that variable rate products go up and up and up and up, they don't. It's not like the stock market that keeps going up, and then it has, it stays within a range, which means 50% of the time it's scary, and 50% of the time it's actually really good.
Yeah.
And so that's one piece, but that also scares people too. And so what we will do with the calculator is we'll just jack up the rate. We'll just increase. Hey, what happens if it goes to 12%? Just to run this crazy scenario. What if rates go up by 4 or 5 points?
Right.
And see
Like
what
you said,
happens.
let's go to that extreme, right? Like you said before, let's go there. You want to go there? Let's go there.
Let's answer the what ifs because if this is going to hurt someone, I don't want you to get into it.
Right.
And if there's a concern or a worry that someone has, I either want to confirm that worry is legitimate, or I want to show them that it's not. And when you're going to pay off the house really fast, the range of rates at which this becomes dangerous is much wider than it is with an amortized mortgage. That's the same thing. People take their understanding, which is legitimate, of the relationship of rates to the overall cost. They take the relationship that an amortized mortgage has, and they apply that here.
Yep.
And so that means if I do that, that means that if the rates change a little bit here, it's got to be terrible for this. Well, we can't know that. We can't know. We can't assume that the relationship between the rate and the rate changes and the overall cost is the same as the loan that we know about, because they're two completely different loans. So, I know, just because I, do this almost every day, but I know that the relationship is very, very small, which means the rate concern conversation, even from a variable rate standpoint, deserves to be on the bottom of the totem pole.
Right.
But just because I know it doesn't mean that anyone else, that we've proven it to them. And that's what we do on our calls, is say, hey, look, what if the rate goes up a bunch? Well, let's just see. Well, I know it's going to happen, but I wouldn't expect for anyone to trust that until we actually prove it out for you.
Yeah, I totally agree with that, and I like the way you were phrasing it there and going about it and letting people know that there are people out there that just say that this is the greatest thing for everyone, blanket, and they'll go out and just say that everyone can utilize this or everyone can utilize a product like this, when that may not be the case. I think they're putting people in a pedestal and saying like anyone can do this. Well, yes, technically anyone can, but should everyone do this?
Should everyone?
And that's where I think like myself and others that are in the same boat as me, we go about and we try to show and coach people, hey, listen, this is just an option. There are many different levels to finances. This is one of them. it's a very powerful tool. It's the tool that Corinne and I used to get completely debt free before the age of 40. So we know firsthand how to actually utilize it. We also understand who it's best for because we're in that boat and we understand it. Now, I always like to say, and I'm an optimist by heart. I look at things and saying everyone can get to this point. There are just things that you need to do. If you're not there, there are things that you need to work on in order to get to that point, and then we can start putting it again. I like to equate it to driving, right? When you're first starting to drive a car, you don't know what to do. It's a very powerful unit, and it can hurt people if done
Yep.
improperly. You can hurt yourself and others. But you do a little bit of training, you do a little bit of learning, you got to learn the basic skills, and then once you're there, now you have freedom. You can go and drive a car. That's a big thing,
Yep.
and you're not a danger to yourself or to others. So
Yeah.
I like that aspect of it. I like the way the calculator goes about and breaks it down.
Hmm.
And then I also like the idea of where, whether they're coming to me first to discuss whether they need this, or they go and they click the link and they go and they're a qualified person and they schedule a call with you and your team, and then you walk them through the process. Either way, they're going to get, I like to say, like a speed bump. Again, sticking with the car analogy, they're going to get a little bit of a speed bump to ensure that this is really something that they can utilize, and they get that educational piece behind it. Because
Yep.
I think you said it great, where you don't want to put harm onto anyone. You don't want them to hurt themselves because it can spiral out of control. This is a product that can.
Well, that's true, and I think that's important to name. Um, the massive, crazy benefit that we talk about that is available with this is as equal to the danger that it can bring to.
Absolutely.
And we lead with the education, because we want people to know this extremely well. We want you to, if anyone chooses this, we want them to know how they control it. One thing that's good about an amortized mortgage is you don't control it. It's a double-edged sword.
I was going to
It
say
controls,
that
it
that to
controls
me,
you.
I hear
Right?
that and I'm like, I don't control it.
You hear that, right? And people who cringe with that learn about this, right? But a lot of people need a fixed payment. They've got their car, they've got their home loan, they've got their other fixed payments, and then they know how much money they can spend,
Mm.
right? That's the beginning of fiscal responsibility. Then then it's like, okay, I'm going to spend less than what's available. Now you're controlling it a little bit,
Okay.
right? Now I'm going to spend a lot less. Well, now I want to be able to control other things financially. But if I don't have the skill set
Yes.
to be able to spend less than I make, right? If having that fixed payment helps me budget, then, and I need that fixed payment so I can budget accordingly, then having the wealth building tool of the amortized mortgage is good for that person.
Yep.
Because this is one where this loan doesn't control your pay down.
Yeah,
You
I can
control your
attest to
pay down.
that. I can attest to that. Corinne and I, when we first started our debt-free journey, we needed to learn how to effectively budget, and
Yep.
having fixed costs does make it easier because it's not going to change outside of
Yep.
perhaps with the mortgage, maybe just taxes and whatnot. But outside of that, what your payment's going to be, right? And
Right.
again, I like how you lay it out. I like how we're very plain. We're not trying to hide anything. It's
Yeah.
all education. We're
Yep.
very blunt. You were very blunt in saying your interest rate is going to be more.
Yep.
It will most likely be
Yep.
higher on a HELOC, first lien HELOC product versus your traditional amortized
Yep.
mortgage. But is that necessarily the driving factor? Like, is that the only thing that's there? And I like that because, again, it's the education piece. It's getting
Mhm.
to see whether the person is open minded and if they're coachable, because again, this is an individual. We know the benefit. You and I know the benefits. We're living products of it, right?
Yep.
It's just getting it out to the masses and saying, hey, listen, we don't have to always go this route. We don't always
Right.
have to go there. And one of the greatest things that I think now that people don't even know, I'm trying to get people that I know and that I know that are fiscally responsible to say, hey, listen, maybe if you wait a year and accumulate some more down payment, we can do this on a first home, right? This is not necessary, or
Yep.
maybe a new buy. It doesn't necessarily have to be on your current mortgage. What
Yep.
about you're renting and you want to buy your first home? We have that availability right now. We have that
We do.
availability
We
with
do.
that.
So we do. A lot of times people who are first-time home buyers, I have people that approach me and say, hey, can you work with first-time home buyers? The answer is yes. There's there's a context, or there's a presupposition that comes with that question, which is first-time home buyer focused loans have down payment assistance programs for people,
Yeah.
right? This doesn't. So can we work with first-time home buyers? Yes. You got to have 10% down.
Yes.
And so
That's
I
why I'm
go to
like,
90%.
maybe if you just wait a year,
Maybe if it just, yeah, right.
just
If you just
wait
waited a
that
year,
year, accumulate.
right? And but even then they're like, well, how do you know if they're a good fit? Well, a first-time home buyer is a good fit for any. It's the same. It's the same. Should you get this, right?
Yeah.
What does your cash flow look like, and how long are you going to pay off the house? What we look for, our cutoff is if someone's going to take, if they put in their numbers, and it's going to be longer than a 13-year payoff.
Yep.
We actually we're the anti-loan department at that point.
Yep.
And so our team, like the loan officers on my team, we tell people not to get it. That's really our function is more of a protector at that point than someone who's a salesman.
Yeah, I like that because again, you're not just looking out for one person's benefit, meaning the bank's benefit, right? You're
Right.
now looking out for the individual benefit as well. And
Yep.
that's very counterintuitive. Like you just said, in a sales type of mindset, that's very counterintuitive because it doesn't bring home the bacon, so to speak.
Well, that also goes back to, with most products, if the wrong person chooses it, it won't ruin them. If you get into the wrong amortized mortgage, you know what your payment is. That's not going to ruin you financially. If you're at a car lot and the guy upsells you to get the high end car instead of the medium car that you came for, it's not going to ruin you financially. This is one where if someone doesn't control this, right? If someone doesn't manage this in the way that this needs to be managed to succeed, it's either going to be stagnant or they're going to increase their balance like crazy. Mm-hmm. So I'll give you an example. If there's a household who they're kind of tight on their budget, let's just say they bring in 10,000, they spend 9. So down by 10, up by 9, but they don't really track it. They don't really know what their spending is. It's not hard to overspend.
Yeah.
It's not hard. And if for a household that isn't dialed in on that and they overspend by $1,000, now it goes down by 10, up by 10, right? Well, let's say we follow that trend a couple times, right? And now our lifestyle, because we haven't been paying attention to our spend, our lifestyle costs $14,000 and I'm only bringing in 10. So we bring in 10,000, I deposit that to the HELOC that pays it down by 10, but then my lifestyle requires 14. So I take out 14. Well, I've increased my balance by $4,000.
Yep.
Right. That's the danger that comes with this. That's why we can't just sell this to anybody.
Yep.
We have like a much higher ethical obligation because the pain, the danger that comes with this is much higher than getting the wrong person into, getting them to buy, a different kind of coffee,
because
right?
Technically, going back to our endless cycle that we were blaming the banks for originally, right? With the regular amortized, now you're just getting them into an endless cycle where they're now going to wind up paying a heck of a lot more potentially because they're never going to pay off the house. And now the interest is now on that higher balance.
think about this, and I know like 10,000 in, 12, 14,000 out is a pretty extreme example, but in that example, if you think about 12 months of that, 1 year of that, they now owe $48,000 more on their house than they did when they started this.
Exactly.
That's the opposite of what we want.
Absolutely.
Yeah, the bank is receiving interest income on a higher balance, but from a risk standpoint, that's really, 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 the bank doesn't want that either.
Yep.
One of the reasons why our bank loves this product so much is because the balances do decrease. Yeah, they're receiving less interest income on lower balances, but one thing I've learned is that yes, banks are about profit, but there's a whole nother side that's, I think, even bigger, which is they're scared of risk. And
Yes.
so when the loan to value decreases on any home, that means if that home defaults, it's easier for them to get the money back because there's less that they have, lent in there. And so they love it from a risk standpoint. And so, but their appreciation for that and their love for that is predicated on the fact that the balances have to be going down.
They have to. Absolutely.
Right. And so it's a really crazy win-win for both the bank and the client, because the client ends up saving money, which you would think would be bad for the bank, but from a risk standpoint, the bank loves it. And so our job for the bank is just to get more good loans in.
Yep.
Right. So that they continue to lend out money. And so even from an interest income standpoint, the reality is because the rate's higher, the bank earns more money based on the dollars that are lent out in real time. So when you pay your loan back, they just go reinvest that money somewhere else.
Yeah.
And so, but because the rate's higher on this, the balance for the client goes down, so they save money, but the amount of money that the bank is deployed out is receiving at a higher interest rate too, while the risk goes down as well. So it's a win-win for both the client and the bank when it works.
Right.
And when it doesn't, it's the opposite. It's risky for the bank and it's risky for the client. And so, so that's why we do that. And let's say we didn't do it because we're good people, right? Let's just say we don't care about people, and I mean we do, but let's just say we don't. The reality is all we need is a couple people to default. All we need is a couple people to ruin themselves.
Yeah.
And they get some foreclosures. They're going to shut the whole program down.
Yeah.
And so even if
that hasn't happened.
No, it hasn't happened
yet with your product.
No. And so over 2,400 loans over the past 6 years. It hasn't happened. And so all in all, the risk for the bank is great, but from a client standpoint, it is our job to vet people out. And then for the ones that it works, we don't have to convince them.
Yeah, that's the greatest
we
thing,
just need,
right?
It's crazy. And if they don't get it, they don't get it. It's okay. But they know about it, and that's a win for me. Exactly. And so, I don't think it's a waste of time at all to teach people, even when it doesn't work, to teach them about it, because they've grown, they've learned about something new, and there may be a season of their life where it does work. The first 2 years that I worked with this, I didn't have one. And people would ask me, do you have a first in HELOC? I said, no. Well, you think it's the best thing since sliced bread. Why don't you have one? I was like, what's the number one thing that you have to have for this to work? Right? I'm like, well, cash flow. Is like, well, I've got 3 kids in daycare.
Exactly.
Right? I have 3. I like that. I don't have any money. I don't have any extra money. Right. Like I can call my parents to borrow money sometimes. Right. And so
that was right there. It goes to show, like, again, my journey was essentially the same. I was in a whole bunch of debt. I had to reevaluate first before even being able to get to this type of position. Right. We just because you learn about it doesn't mean that it's always the best thing for you. Anthony, I love that we both agree on education first, 100%. And then 100%. Going out and making sure that those who we do bring on to this product, that they are, I love this phrase, we set people up for success, right? We're not necessarily looking to just push something. My whole goal is to get people to a point where technically I am, and where they have more freedom and more ability to go out and do things that they like more, because they have that freedom. They don't have that extra payment that is on their income every single month. They have a little bit more of that flexibility.
Yeah.
And the education point behind it. And that's why I love being hooked up with you and your
Yeah.
company. Again, your product is what I utilized, and it's the one I'm most comfortable with. But there are others out there, if people are to be aware. But I like this whole education aspect, and I don't know if that many people are doing that portion of it, at least from your end, in the bank system, of where they're pushing that much of that education and weeding out and making sure that it's the right fit for the right person. I'll be upfront
I'm not
honest.
sure.
I'm not sure, but
There's some safeguards in place. I don't think to the degree. I can't fully speak for other people, but I don't think to the degree that we do.
Okay.
We embody the education piece, and the outcome of doing a good job with that is we get the loan.
Yep.
The qualifiers to qualify for the loan are pretty standard are pretty standard mortgage qualifiers. That has nothing to do with whether someone's going to succeed with this.
Right.
Whether your debt to income is high or low may have some sort of relationship between the two, but there are plenty of people that could qualify for this that spend all the money that they make. Right. And so to me, it's about how much of your money are you spending. It's a different focus.
Yep.
There are a lot of people who are self-employed, and they write everything off on their tax returns, even though their business is cash flow really well, right? Which means they hired a good CPA. That has nothing to do with the amount of money the cash flow their business makes. I mean, there's a slight relationship between the two, but if you hire a great CPA, they're going to write everything off. And that could be someone that could be a really good fit for the program, but the method for qualifying that we uses tax returns.
Right.
And so that's a scenario where someone could be a good fit for the program, but we can't qualify them. So strictly going off of qualifiers, like most loan originators do, doesn't directly relate to whether this is a good fit for a person, which is why we lead on the front end with the vetting and the education piece of it too. So yeah, absolutely.
That was amazing. Anthony, listen, I want to be respectful of your time. I greatly appreciate it. Thank you so much. I'd love to have you on again if possible. We can make it work.
Absolutely.
Just to continue down this rabbit hole and really get people out there and learn more and more about this. So Anthony,
real quick, a couple, if that's okay. A couple things to know, qualifier wise.
Sure.
I want everyone to learn about this, but in terms of the loans that we're able to do, I want to hit a couple things. First thing I have to say is, anything I said today is from me, and I don't represent the bank. I'm not representing their opinions. It's just all from me. So whatever I said is not associated with them. I'm not representing them. I'm representing myself. Also qualifiers. So a couple things to know. You're going to have above a 680. So whatever system you're using, credit score, above a 680. If you're looking at a credit score model, make sure it's showing a 690, because whatever we pull is going to be lower than what you're seeing. I can't do Maryland. I can't do Texas. I can't do Hawaii or Alaska. Learn about this, take advantage of our resources, but I can't help you with a loan in those states.
Okay.
I can't do manufactured, mobile, or modular homes.
That's something interesting about that.
If you're on over 20 acres of land, I can't do that. Let's see. Those are some basic ones. We need to have 5% reserves somewhere of the line. So if you're getting a $200,000 line, I need to show $10,000 in reserves somewhere. That can be a checking account, savings account, any liquid investments that you have. We can do cash value of life insurance that's you're able to borrow from. Yeah. We can do 401k IRAs that's vested that you can borrow from as well.
Okay.
So those are just some things to keep in mind in terms of hard stops. We have to have 4 years after a bankruptcy or foreclosure dismissal. So those are some things to keep in mind as you go forward, because we want everyone to learn about this, but I just kind of want to be upfront about some realities with our loan too that
Oh
comes with
yeah,
that.
of course. Yeah, again, we're all about the education, and if that means that we can't move forward with it with you because of these qualifiers, then instead of having you go through the entire process just to get let down because of this, then that
Right.
could take the wind out of someone's sail, so to
I
speak.
can. I can.
So awesome, Anthony. I greatly appreciate that. Thank you. I
Thanks
would
for,
like to definitely touch into more of those qualifiers maybe
yeah.
next time, and to see maybe why, and understand the whole reasoning behind it. So that's
I'd
awesome.
love
We can
to.
look into that for topic for next discussion.
Perfect. That sounds great.
Awesome. Thanks so much. And for everyone out there listening, if you're interested, again, there's going to be a link in the description. I'll leave Anthony's information in the bio, in the link, rather, in the description of the video as well. If you want to reach out to him directly, if you want to reach out to me directly, please do so. Leave a comment. What are your thoughts? Have you done this loan? Have you heard about this? Are you wanting to know more? Leave a comment. Get in touch. Let's learn about this together. And until next time, God bless.